All right, so here's this business that has 1/3 of all the online purchases in America, and it's so far ahead of the competition. And this business, over the past 20 years, has seen its revenue go up 100x from about $5 billion 20 years ago to over $500 billion today. And although this business is so big, I think they can come up with a lot of different ways that they can grow into the future. There's new countries they can go into. There's new product selections they can grow. There's AWS as well. There's lots of avenues here for further growth. So should we invest alongside one of the greatest businesses that's ever existed? And apparently it's only day one at this business. So in this video is how I calculate the value of Amazon shares. So I want to get a feel for the growth rates so I can project them out into the future. So to do that, I'm going to look at the past. I'm going to read the annual reports and let's see if we can get some sort of feel here. So here's a revenue chart for the last 20 years. It's grown from about 5 billion to well over 500 billion. So we'll just say 5 billion to it's about 530 billion at the moment over a 20-year period. And to calculate that growth rate, we've got, there we go, 26% or so over 20 years. Now that's revenue. So if I want to do like, say, past 10 years, I'm going to do like a 20-year period, a 10-year period, maybe even a 5-year period, something like that. So for the last 10 years, we've got from 2012 to 2022. We'll do, yeah, we can do 2022. I think that's good. 60 billion to 513 billion, 60 billion to 513 billion over a 10-year period. And compared to the 26%, we're now at about 24%. The past 5 years, we've got, so 17, 18, 19, 20, 21. We'll go from 18. So 232 to all the way up to, we'll go from 17 to 22. So 177 to 513, 177 to 513 over the past 5 years. And that gives me, there we go, about 23% again. So we're somewhere between sort of 23, 26%. It's a massive company now, are doing over 500 billion. Can it keep up at those rates? I'm not sure, but at least we got a feel for 5 years, 10 years, and 20 years. So now I'm going to look at gross profit and do the same kind of calculation. And I'm just getting all this data, by the way, in TIKR Terminal. So there'll be a link in the description for if you want to get access to TIKR Terminal. It's amazing for all this data. You can pull international companies as well. I highly recommend. This is what I use for all my research. So I'm going to do gross profit. Let's look at the past 5 years, 65 to 225, 65 to 225 in gross profit over a 5-year period. And we're looking at 28%. Let's do a 10-year period, 15 billion to 225, 15 billion to 225 over 10 years, 30% now. Okay, so gross profit has been there, and I can even prove that by, look, if you look back in the gross margin percentages, they were sort of in the 22% range, building their way up to 30. Now they're in the 40s. So over time, they've been able to improve their gross profit and their gross margins, which is really exceptional to see. We all know this is an amazing business, but we're just trying to get a feel for these growth rates. The next thing, what's really important, the growth rate I want to look at is this cash from operations. This is how we're going to do a lot of our valuation work. We're going to look at cash from operations to understand what we're going to call a free cash flow number. And this cash from operations, we want it to sort of be in the realms of the revenue and the gross profit. So let's have a look at that. So 17 to 22, we got 18 to 46 and a half, 18 to 46 and a half over a 5-year period, and we're looking at about 21% or so of the cash from operations. Let's look at a 10-year period. So we've got 4 billion to 40. If we look at the last 12 months, it actually says it's 62. So it's jumped up a little bit from 2022 to the trailing 12 months. We might use that trailing 12-month figure and go from 2013 to 2023. This would be, the problem is 2023 is just not finished yet. That's also, but it's probably a reasonable metric. Yeah, I think we should go for that. So let's look at that. 5.5 to 62, 5.5 to 62 over a 10-year period. Let's have a look at what that looks like. Okay, 27%. Okay, so I think we're getting a pretty good feel here that we've been growing anywhere from about 20 to 30%, somewhere in that over the past 5 and 10 year periods. I'm pretty comfortable with those growth rates. So that's how I look at growth rates. And then I'm going to look at the annual reports and I'm going to see like what is coming in the pipeline and what are they unlocking and what do I think they can do? Can they keep that going? Can they grow faster? Can they grow slower? What do I think is going to happen? And there's a bit of, that's where the nuance comes in. Now, all these calculations that I'm doing require a fair bit of nuance and a lot of research. And I keep track of all of this in a weekly report that I call Yes Stocks, No Stocks. And you can get this each week for free. It's not some boring newsletter. It's straight to the valuations. There's no BS, there's no fluff, and I highly recommend you joining because a lot of the work has then been done for you. Okay, so I've got a feel for growth rates, and what I've done here is I've put in, these are probably a little bit on the optimistic side. I just feel like 23% for another 5 years and then 20% for 5 years after that. That's a pretty big ask for such a big company, but they've been able to do it for a long period of time so far, so we can give them the benefit of the doubt that they are just an amazing business. So let's use those as the growth rates. My return on investment goal, the discount rate, we got to just try, what we're trying to calculate at the moment is like to get a 10% return on our money, which is a little bit better than the S&P 500 or an index or something like that. Amazon being a great business, we're trying to find out what I guess like institutional money would think is like a fair value, like a fair return that they would like to get. They'd probably like 10%. So that's why I put it in 10% here. I don't personally want 10%, but I'm just using 10% as my like figuring out the fair value of this company. The multiple we could sell it for after 10 years, I put that as 25, which is a little higher than what I normally recommend, just because those growth rates are epic. This is essentially one of the best companies in the world. So let's assume it's going to get a reasonably high multiple of 25. Next in line here is this operating cash minus maintenance capex. Now, it's essentially free cash flow. And if I look in TIKR Terminal, I can look in the cash flow statement and I can scroll down to an area where it says free cash flow. Now, the thing is, it's not really going to help me a whole lot because what I want to do is I actually want to calculate. The reason it's not going to help me is because they've calculated it from cash from operations minus all the capital expenditures. But the problem is a lot of these capital expenditures are for growth, not just for maintaining the business. What I'm trying to figure out is what money would be left over if they didn't want to grow. They just wanted to pay all of their extra money out to the owner of the business, which would be us. So we've got 62 billion or so and about 58 billion in capital expenditures. But if I Google Amazon CapEx, I get this thing here called Guru Focus. And I don't want to sign up for Guru Focus because I don't want to pay for it. But you can, when you Google this, you can type in this, it will come up with this earnings power valuation. And it's a bit of a trick here. If I look for growth CapEx and maintenance CapEx, here it is here. Maintenance CapEx, average of the last 20 quarters has been about 31 billion. That's a fantastic number for us to use in our calculations here. It means that about 31 billion of the money is going to maintain the business. Therefore, there's about 30 billion left over. And in my that's where I get this $30 billion number from. So the operating cash flow of 62 minus that, or 61 and a half or whatever it was, and then minus the maintenance capex of about 31 leaves us with about 30. And the shares outstanding number I've just pulled from TIKR Terminal as well. I'll show you exactly where I get that number from. Go to the income statement section here, and in the income statement I scroll down to the bottom where it says weighted average diluted shares outstanding, and there it is there, 10.3 billion. Okay, so I put that number in. And the last little section here is I want to look at the total cash number and the total debt number. So I go back I want to go into the balance sheet. The total cash, which is in short-term investments, is about 64 billion. So I can put that in here, 64 billion. And the net debt number is what I'm going to do is I'm going to go down into the liabilities. And I'm really looking for this long-term debt number here. That's probably fine. Current portion of long-term debt. Let me have a quick look at this. Yeah, long-term debt is probably enough here. So that's about 70 billion. There we go. So they got a little bit more long-term debt than they do cash. That's fine. And it says I want to buy this at around about $203 at the moment. And that would get us our 10% over a 10-year period. And that's sort of where I'm starting to figure out a fair value for the Amazon stock price, about $200 a share. Now, the next valuation method I use is what I call just the 5-year valuation. So what I'm doing here is I'm just going to get the current revenue number, a growth rate for the next 5 years. I might put that up a little bit higher to 23%. And then the estimated free cash flow as a percentage. So what I calculated was the 30 billion number of the 538 is about 6%. And I'm going to say that they're going to maintain that for the next 5 years. Like the free cash flow is a percentage of their revenue. And a fair future price to free cash flow number of, I'm going to say 25, gives me a 5-year target market cap of 2,200 billion. The revenue would be 1.5 trillion in 5 years' time if it can grow from 500 billion today. So it's a triple. Yeah. So and then there's a little bit of a dilution rate which I've found from looking at the shares outstanding number and how that was increasing over time. It's growing at about 1.5. I think it's about 1.5% dilution rate. And the shares outstanding number, and I put in the current market cap, and it's telling me that I want that in 5 years the target share price is going to be around about 207. It's just. And then considering the market cap is 1.4 at the moment, and we're going to try to get to 2.1, saying that we're going to get a 9% compound annual growth rate, which means that we're probably around fair value. What I will do is I'll adjust this to get to 10%. So if we have about a 7% price drop from whatever it is today, which depending on the day you're watching this video, at the moment I'm looking at it's $138 a share. So we're probably in the ballpark at the moment. The price might need to drop a little bit, maybe 130, something like that, 125, and that would give us some sort of fair value for Amazon based on the next 5 years. Now, the next thing I want to do is I want to go back now to my DCF valuation and have a look to see whether I think these are actually reasonable growth rates, or could I be a little bit more conservative? And I really think I should be a bit more conservative. I want to put this down to 20% for the next 5 years, 15% for the years after that. Look, this is just like, I know we looked at the 5 years and 10-year historical numbers and they're sort of in the mid 20s, but for it to keep growing at those speeds just seems more unlikely than likely. So I want to put those numbers down just a little to give myself a bit more, to be a bit more reasonable, I think, what a more likely scenario would be. And we're now talking at about $150 a share. So we had the 5-year valuation at, what do we got? About, whatever 1.3 trillion market cap is, which is around about $125 a share. Yep, about $125 a share. And my DCF is telling me it's about 150. So somewhere between 125 and 150, I'm going to call it 135, which is around about the price that it is today to get our 10%. Now, like I said earlier, this is not what I particularly want to get. I don't want 10%. So I'm feeling like the business has to do quite well just to get the 10% at these prices. So what I really want is around about 22%. And to get 22%, well, now it says I need to buy the stock at around about $62 a share. For my 5-year valuation, I would have to buy, to get this number, my 5-year compound annual growth rate, let's see, that's a bit 800. Okay. At a market cap would have to be 800 million, which is around about a 40% drop in what it would need to go from today's prices at 138. So we're talking around about 60, 70, maybe $70. So where I'd be really comfortable buying the stock is not at $138 or in around the, what I would call fair value, $130, somewhere around there. I would like to buy this at about 60, 70, somewhere around that, which is about a 50% drop from where it is today. And if I got that number, I think I could get this 22% compound annual growth rate. Both my DCF method is telling me that, my 5-year valuation method is telling me that. That would be where I would put what I would call a buy price, even though the fair value is about $135 a share or so. Now, remember, I'm going to keep track of this each week, and it's free for you if you want it in yes stocks, no stocks. There's a link for that in the description. And next week, I'm going to go into NVIDIA. Looking forward to jumping into that. Hope you are too. See you then.